Alrighty, Jonathan. I don't know if you know this, but in the last 7 days or so, I have been lucky enough to speak with two legends in real estate investing, two big players in the syndication space. One was Brandon Turner from Bigger Pockets fame, and the other was the one and only Grant Cardone. In those discussions, we talked about a lot of things, but I think is most interesting for our discussion this morning was the talk of Class B and Class C properties, frankly, collapsing. And second, the window of opportunity might be shorter than I was expecting. So, Jonathan, I'm assuming you know both of these individuals, yes?
I do. I've actually was interviewed by Brandon years ago on the Bigger Pockets podcast. And
Cool.
Grant Cardone, I only know him by reputation, but I've never met the man.
Yeah. So we'll go through them in the order. I spoke with Brandon first and then Grant second. So we'll do the same thing. The videos are on my channel, guys. If you want to watch them out. The really interesting thing with Brandon Turner, to catch everybody up on obviously Bigger Pockets fame, he started with a house hack. You know, he has this stack method, right? Buy a house, a duplex, a quad, 10, 20, and now he's doing mobile homes. In that discussion, he talked about a couple of his syndications really struggling.
Yeah.
And, I don't know exactly what's in his portfolio, but having had conversations with him and others, it sounds like there's a lot of mobile home parks, right? Which I'll call Class C, maybe Class B, again, not to be derogatory, but they're certainly not Class A properties. I think that's fair to say. And the one conversation we had in there is, I'm like, Brandon, Class A is trading and it seems to be a 25 or 30% discount. I can't imagine Class B and Class C going for anything less than 50% off. And, that you could see kind of a gut punch there, but he's like, might happen. So it's coming, right?
Yeah. Well, listen, I mean, that 50% number sounds crazy, but when you think about it on a cap rate basis, it's not so crazy, right? And so what I mean by that is the Class C properties at the height of the bubble were trading at 4 caps, right? And that was because people were believing that they could buy a property, very quickly rehab it, push rents, increase NOI, and then at that low cap rate, you really create a lot of value, right? Problem is that only works as long as it works, right? When you know what I mean? Like it's a little bit of a game of chicken. I mean, at the time, people thought, oh, this is going to last forever. But cooler heads were like, these properties historically are trading at like 8 caps, right?
For a reason.
Right, for a
reason.
Right. They're trading at 8 caps because there's more risk in lots of different ways, right? There's tenant risk, there's building risk, right? So the market demanded higher cap rates on them. And now within a higher interest rate environment and all the capital pulling back, them going back to 8 caps where they historically traded, and maybe even on the boomerang effect beyond that for a while. Yeah. You can see how these properties are going to really take a hit. And, the lucky folks are the ones that, executed their plan, have got the rent bumps, have fixed rate debt, and can just sit there for a while and not do anything.
Yeah, 10-year Freddie debt is looking really good right now.
Yeah. So if you're in that situation, well, you know what's going to happen. You're not going to make as much money as you thought, but
you'll keep the property.
You'll probably be okay, right? And maybe this is a property that 10 years comes around, your debt is due, you're still, the price is still really not. You could see a scenario where the price still is still not really where you want it to be, but you can refinance the debt, and then you hold it for another 10 years.
Yeah.
And then after 20 years, you sell it and you made a nice profit. And like, frankly, at that point, you're not even thinking about this deal much anymore. And the $50,000 you put in 20 years ago, now is worth 100 or 150. And you're like, okay, this is not bad.
Not bad. Yeah.
But you're just not making those huge, fast profits that people came to expect. But yeah, giving up 50% of the value is, I think, totally realistic.
Yeah, it's absolutely. So if we kind of move that conversation to my one with Grant Cardone, he agreed as well. I asked him essentially the same question, almost verbatim, and they both agreed. The thing that Grant really got, two things that during the Grant conversation that kind of caught me. One is he actually believes the opportunity for wealth creation this will be his biggest wealth creation opportunity of his investing career, which is kind of crazy to think about, right? He's arguably a billionaire, maybe half a billion. It doesn't matter. But he's already doing deals now, right? He obviously plays in Class A stuff. But he agreed. Yeah, he said like Class B, Class C has to take haircuts, and it has to be massive. But the one thing he did coach me on that I didn't connect is he basically said, Michael, the window of opportunity is going to be a lot smaller than you think. Because I was indicating, I thought this might be 3, 4, 5 years, and he's like, dude, it could be 18 months.
I mean, I guess it all sort of depends on what you mean by opportunity, right? Now, when I came into the business in 2011, I remember already feeling like it was like I'd missed it, right? But that was because, in 2009, 2010, people were buying portfolios of apartments for $7,000 a door because the banks were just trying to unload them. And of course, I missed that opportunity and never would have had access to it anyway, right? Because I wasn't on the bank's list, right? And didn't have and they were looking for cash, right?
Yep.
So yeah, the opportunity was definitely gone. But if Grant Cardone is suggesting that there's going to be a brief window of opportunity to get great bargains and then prices are going to go back to where they were before, I don't buy that.
No,
because
I think, go ahead.
I was just gonna say, like, I think that, maybe he's right. There's going to be a limited window for people like him who have a lot of cash where there's going to be distress and they can step in and buy distress at like really, really like great prices. Yeah, that opportunity is going to be fairly short, right?
Yeah.
But when you're talking about just, cap rates going back to more normal levels, it's going to be like the market clearing. Like the market is still going to take time to clear. And the reason for that is that sellers are just going to not be real. Like they're going to have to be forced into being realistic, and they're going to hold out as long as they can. And just like in the great financial crisis, we've talked about this before, the multifamily market did not actually bottom until 2013, right? It took 5 years. And I think this will be the same or potentially worse because the scale of the problem is bigger, right? There wasn't a bubble. Here's the thing. There was no bubble in multifamily.
Correct.
In 2006, 2007.
Correct.
There was not. People were buying even at the height of even with interest rates crazy low, and, multifamily was still trading at 8 caps.
Yeah,
right?
That was reasonable. Yeah.
Yeah. And so that's what the market expected. They thought that these assets were a bit risky, right? And there was no bubble. This time there has been a huge bubble. People really overpaid. It's going to take a long time it just attracted more attention than ever before, this asset class, and unwinding it is going to take more time. So and the discounts may be deeper because there's an equal and opposite reaction to everything. I mean, the price went higher. The reaction is going to be greater to get us back to the long-term trend, right?
Yeah,
so
the reversion to the mean or the snapback is going to be nasty.
Yeah.
In this. Yeah. And the one thing that when I kind of think about blending Grant and Brandon's conversation together, the other thing that I think is really obvious is, and again, this is specifically Class B and Class C, because I could argue that Class A is already trading or starting to at least trade. It's like, like when you're a kid and you kind of pinch the hose and the water stops.
Yeah.
That's what we're doing right now with extend and pretend. Eventually that water pressure is going to come, and it's going to go fast. Like when the banks finally give up. And I think we're setting it up because yesterday we obviously had a hot inflation reading. We had another hot inflation reading today, although the rates are down today. They were up yesterday. But what I think's going on in the background is more and more banks are starting to see that they're not going to get this magical 50, 100 basis point more in cuts. Rates aren't going to come lower and provide some cover. So this water pressure, this backing up of extend and pretend, I forget what the numbers are, but something like $1.5 trillion got extended a year, and that's on top of another 1 trillion. And pretty soon, Jonathan, we're talking about real money.
Yeah. And listen, the thing too is that there's I've seen people talking about the fact that the extended loans are like more likely to default, right? Like
Oh, of course,
they default again. It's like it's not like the the I guess it's like the redefault percentage is extremely high,
it is.
right? So it's not like a lot of deals get saved by this, but I think the whole extend and pretend logic is, hey, let's kick the can down the road and hope that interest rates come down and give us some relief.
Yeah.
And for some deals on the bubble, if there was some interest, if you got 100 basis points of interest relief, it would make a difference, right? But there's all those properties for which it wouldn't make a difference because they're just that's not enough, right? But I think the chances of people redefaulting are very high, and
You know what the sad fact is?
eventually work its way through the system. What's the sad fact?
The sad fact, again, I've been through this movie before. I've watched properties do this. The owners of that property who got that extension are not maintaining their building.
Yeah.
And that's why redefault risk is high. And oh, by the way, the bank's asset value is going to go down. Right? And there's a building, again, we've picked it up for half the price of what it sold for last because the bank gave the lender or gave the borrower a 1.5 year extension because they were just hoping somebody would come in. And the owner was happy to get it because they didn't want a foreclosure. But they stopped maintenance. They stopped all capital improvements. They stopped tenant selection. They were just bleeding the property dry.
Yeah.
And then finally the bank got smart and drove by the property and realized they had a slumlord property on their hand and they were forced to foreclose. That's what's happening right now. If you're an owner of a property and you've lost all your LP money and you're down another 15 or 20% of the value and the bank's looking at a haircut, the bank gives you a year, of course you're going to take it.
Yeah.
But you're not going to throw good money after bad.
Yeah, and also, I mean, here's another thing too. A lot of these extend and pretend deals come with like having to purchase another rate cap or something like that. So that's where the money is going, right? They're escrowing money to buy the next rate cap, right? And if you're doing that, you can't afford to do anything but like the absolute necessary maintenance, right? And you're just cutting corners everywhere you can. And that's the danger of overpaying for property. I mean, just said it. We've said it over and over and over again, and I see people on LinkedIn saying this more now. It's all about the basis. Yeah, I mean they're 5 years late to saying it, but it's like all about what you pay for the property. You make money when you buy. This is an old adage for a reason. It's true, right?
Yeah.
It didn't go away just because people were buying with super low interest rates and just doing financial engineering and then flipping the property and making money. Right? It was all just speculation that worked for a while, as it always does, right? And because it works for a while, people say it's true. Oh, you don't need to pay attention to buying at a basis, whatever. You can do this and that and the other thing to your property, but it, to the capital stack, not to the property, right? And it just doesn't. At the end of the day, somebody gets caught holding the bag. And I want to go back and just highlight the size of the opportunity that's coming and why I'm so excited. I'm going to go back to that video we did years ago where we turned a $100 million building into a $48 million building. And the reason I want to go through this is just highlight what led to the 100 and what will lead to the $48 million value. So again, $100 million value, somebody buys that property at a very low cap rate. It's likely going to be value add. They got bridge debt, interest only, probably even worse, because that was the only way they could get the IRR. It's the only way they could financially engineer the number to make sense. They probably get into that deal for 25% down. So they have a note for 75 million, and then they went out and raised equity for the other 25. And they have, another 5 million raised to keep on, for maintenance or whatever it is. But here's the deal. You fast forward 3 years, and you've got to come back and you do a reassessment. Now the value is 48 million. What happens? Well, you might get an extension, again, hoping rates come down, all of that. But let's just say the bank is forced to foreclose and sell the property. So the first 25 million or 30 million raised from LP money is gone. The bank's going to take a haircut on the order of 25 to 27 million just on the debt. But this is why this is the greatest opportunity for wealth building, because the next person to buy that $48 million building
is probably going to have to come in heavy. Let's call it 40% down, or let's call it 50% down, just so I can do the math in my head. So now you're going to have a note for 24 million. You're going to have an equity position of 24 million, but you're going to be able to wait. You can cash flow that building on a $24 million debt structure, probably at 80% occupancy.
Right.
While you wait 3, 4, 5, 10 years for values to come back. And then it'll be worth 80 million, because maybe it was never worth 100. It was just financial engineers, but it's probably worth 80, 75. And then you could go do your burr on the debt in 5 to 7 years, and you have no equity in the deal. Does it kind of make sense?
Yeah, absolutely. I mean, it's like I said, it's all about the basis, right? And the people who have cash to do that are going to be the ones who really succeed, right? And there are going to be deals too that will trade even more cheaply than that, right? I mean,
for sure.
We're seeing, and I think that where that's going to happen is going to be again in that class B and C space, and I think what'll it's just like you're seeing office buildings that are trading. I mean, people are starting to make a bunch of money in office right now.
Oh yeah,
because everybody was scared about office. The banks were scared about office, and so there's no capital for office. Now people are buying office buildings for 10 to 20% of the
scrap
previous
value. I saw a deal in Minnesota for scrap value.
Yeah. I mean, 10 to 20% of the the previous trade price for buildings that are like 90% occupied.
It's
right.
Crazy.
And it's because the market is so, the herd has convinced itself that nobody's ever going to work in an office again. Meanwhile, like Manhattan office occupancy is like back to pre-COVID levels now.
I saw that. Yeah.
Right. And it's like not even, and the return to work orders haven't even really started coming in yet. Like this is just
starting.
It's just starting. So, I mean, I know some guys who were in office leasing, and man, they're having a good year. Right.
No, that's awesome.
You know what I mean? And so, but the people who had the steel balls and just were ready to buy office are going to make serious money because they're buying them at such cheap basis. And this is for performing properties that are operationally performing. Just they had too much debt on them, right? So they couldn't service the debt.
Yep.
And so too much debt on them, foreclosure, very few buyers. What does that mean? Bargains, right? And I think that the same thing is going to happen with your Class C multifamily. It's going to get tarnished. People are going to be afraid to buy it. And then banks are going to be afraid to lend on it.
Mm-hmm. And just like last time.
Yep. And even though you're going to have properties that are actually full, that are tenants are paying rent, right? They're being managed okay, but the debt structure was wrong. You're going to have, very few buyers who frankly can buy these things for all cash because they're not going to be able to get debt on them. And those people who can do that, man, they are going to be very happy people in even just 2 or 3 years. So
this is what's coming. Yeah. To me, it's like now what I'm looking at is what's the trigger? And for me, the trigger has to be, when do the banks acknowledge that they have a problem, right? Even Jerome Powell yesterday quoted that the commercial real estate market has a lot. What did he say? I actually have it over here. What do my notes say? What did he say? Commercial real estate has a lot of embedded losses, but does not seem to be getting worse. All right. So what's going to be the trigger for banks to start recognizing the losses? And to me, it has to be people giving up on rate cuts this year, which seems to be coming.
Yeah, I think it's when they realize that the premise underlying extend and pretend was wrong.
Yeah.
That's when they throw in the towel and they're just like, you know what? We're done. We're calling this in. We're getting a fresh start. Right.
Yeah.
And then I think, like, you said before, then there's going to be a run for the assets. Cause I think, what happens is that as soon as there's price discovery, then all the banks' balance sheets get all screwed up. Right. Cause they have to mark everything. They'll have to mark everything to market. And that's going to cause, they're just going to have to sell that stuff to get it off their balance sheets and get cash in the door. Right.
And again, just like last time, the bank that moves first actually wins. They take the least haircut.
Yeah. And what you're seeing already, like the scuttlebutt I'm hearing, and for people that I partner on deals with, people are so syndicators who are kind of bigger than me have more, sort of cash to draw on
Mhm.
are starting to benefit from the forced sales. See, this is what's happening. The foreclosures are not happening yet.
Right.
The banks were not really banks. I think a lot of these are private equity funds and stuff like
Yeah,
that. But the
probably.
lenders, right, non-bank lenders are leaning on these sponsors to sell. They're like, you sell, you can avoid having a foreclosure on your record, but you got to sell this property because we want you out. And they're going to strong operators and saying, hey, take this deal. And what's happening is that they're also saying to the strong operators, okay, we're going to make you, I don't know, can I curse on your channel?
Yeah, go for it. Yeah.
It's like, we're going to make you a shit sandwich, right?
Yeah.
We're going to give you 2 nice properties and we're going to wrap
give
those
you
around.
an ugly
We're
one.
going to give you like an okay one, and we're going to be a really crappy one.
Right.
And if you want to buy the nice ones, you got to buy the crappy one too. That's the deal. So
Yeah.
a lot of that's what's happening. Friends of mine are doing those deals right now, buying these portfolios where they've got a range of, good to crap.
Mhm.
And frankly, if they're good operators, they'll be able to turn the crap around.
Yeah, yeah.
Right? So it'll wind up being good for them. But as of now, the crap is crap.
It's a heavy lift. Yeah, it's a
There are
heavy
a
lift. in the short
couple
term.
good deals in there to sweeten the pot. And so this is what you're seeing. And so it's not a foreclosure. The original sponsor is not getting that black mark, but their investors are, getting a black eye for sure.
Right.
But these guys live to play another day, which, maybe is a good thing. Maybe it's not.
Yeah. So let me play that out just to make sure I understand. So the GP kind of survives, doesn't get the foreclosure, so they can do this again if they want to. But the LPs take it on the chin.
Yeah, and some of these deals are being structured as, like, I forget what they're calling this, but basically, like, the deal with the GP is, if this deal does super well, then you guys can make some money, maybe get your capital back out, right?
Okay. So
But
it's like a rescue fund or a rescue deal.
it's not a rescue fund because they're buying them, but they're kind of like the GPs, the existing GPs and LPs still, they're getting some kind of like,
they go to the back of the line.
Yeah, they're getting pushed to the bottom of the capital stack, and this new equity is coming in, and basically there's no obligation on the part of the new sponsor to sell it at a price that's going to get any money to those LPs or the sponsor. But if they hit a super home run and there's enough money to like pay back their own investors, and so there's essentially some kind of like metric that says, okay, if we really hit it out of the park, you guys will get some money. So it's not a complete loss to you, but the chances are they won't ever sell for those kinds of prices.
Right.
And they have no obligation to try to hit those prices. Their only obligation is to their own LPs. Right. So, but yeah, so we're starting to see that kind of stuff.
Yeah, so let's play that out, because again, one of the things I'm looking for, in my community is to kind of buy some, again, I've been very clear. I'll 1031 out of houses into these deals if they come around again. But these sound like, frankly, lenders are picking winners and losers, and you've got to be on the quote unquote list to get that phone call. These aren't going to market, if you will.
Yeah, they're not. This is like the lenders are going to somebody else that they lent to who's performed.
Yeah.
And saying, we have a relationship with you. We know you're a good operator. Your deals are all performing.
Yep.
We'd like you to buy this.
Yeah.
Right.
And help us out. We'll help you if you help us, kind of.
Yeah,
thing.
Exactly. So, and they're getting a good price. Right. So, and it's so if you're in that position now, that's very hard to do for new folks or smaller folks or whatever, but you can still go, as I've been talking about, go talk to the local people, go talk to the people in your business community, talk to the, if all you can do is a fourplex, I mean, there's fourplexes out there that people overpaid for that are going to be the same situation. Right. So, just start making those contacts now.
Yeah. Yeah. And the other thing that I'm hearing going on is there's actually people raising money to buy the old debt at a discount.
Oh yeah. Yeah. I mean, there's that, there's all kinds of ways to skin this cat, right? But taking the debt is one, basically buy the debt at a discount, then you foreclose.
Correct.
And you
that's
take
just step one, step two. Yeah.
Yeah. So, that, involves a little more money because you've got to come up with more cash to buy the note than you do to take on, I think these deals that I'm talking about a moment ago, they're restructuring the debt right? Or they're taking on the debt, but they're not really paying
Yeah,
any
no
equity.
no cash, no
Yeah.
net new equity, yeah.
Yeah, or very limited amount of equity, or just like they're just putting in money to do capex for
Mm,
deferred maintenance,
yeah, a
but
little reserve, yeah.
they're not actually putting in like an equity down payment. They're basically taking it over for the existing debt,
Got
right?
it.
That's the price. Whereas if you buy the debt, well, you still have to come up with the 75 mil on the $100 million property. But you want to buy it at a discount because it's probably not even worth 75 million anymore, right? Now you think it's worth 65 and you want to build in a margin of safety, so you're buying it for 50. You still got to come up with the 50, right? Because you can't finance that. But
Yeah.
but if you've got the 50 and then you're gonna, and you've got a good time horizon, then you're gonna wind up making a good deal for yourself.
Yeah. So at the end of the day, kind of summarizing Brandon and Grant's conversation and really our history, multi-years now, kind of telling people this was coming, is it's almost here, right?
Yeah.
The cake is in the oven. It is being baked. It has to be eaten. There's tons of pain coming. And with great pain comes great opportunity. So I do think the wealth opportunity is coming. If you can find the right opportunity, structure deals, and it's almost here. It's almost here, Jonathan.
Yeah, it's a slow grind though, right? I think it's sort of the whole thing moves in slow motion.
Yes.
But it is coming, right? And I don't know if it necessarily comes this year because so much of the debt was extended into next year or the year after.
I'm starting to think 26 as well. Yeah.
Yeah, but I think that I don't think that there's going to be another round of extend and pretend.
No, it's
right
done
after this. So I think that if the rate cuts don't come through, then we're just going to see the dominoes start to fall. And frankly, let's also just throw one other thing out there, which is that in the financial crisis, the rate cuts did come, and it didn't stop the foreclosures, right? It did not.
Once it was done, once that first domino fell,
it didn't actually help anybody, right? It didn't cause the prices to bounce back. It didn't cause it to become easier to finance.
You know why? It was the lenders. The lenders gave up.
That's what I was going to say. Yeah. The lenders were scared. When the lenders are scared, it does not matter what the interest rates are.
No, it's all about cash. And again, we were active in the single family market. And I remember the first time we bought a foreclosure. These numbers will be close. They're probably not terribly accurate. I think the first 3-bedroom, 2-bath house we bought in the foreclosure was like 125 grand. We ultimately bought, I think our last 3-bedroom home we bought was 38 grand.
Wow.
So, I mean, it just never stopped.
Yeah.
And it was wild to watch, all because the lenders wouldn't lend. So I was borrowing money at 12%, to get these deals. So.
Yeah. And if you think about that on like a multifamily property, right? If you have to borrow at 12%, like you just can't pay that much, right?
No. Yeah. But let me be clear. I will buy every multifamily property I can cash flow at 12%.
Yeah, totally. Right. But that's the point, that you can cash flow. That's what I mean by you can't pay that much, right? Because you have to service that debt. And at 12%, that is a big nut.
That's a big nut. Yeah.
And yeah, if you can service that debt and cash flow, then you do that deal all day long.
Every single time.
Because you know that when you stabilize it and refinance it at a lower interest rate, then you're really going to make money, right? And if you're buying it at 12 from a private lender, you can get bank debt for like 8 or 9%.
Oh, easy.
Right? Which sounds terrible, but like if that's now 3 percentage point increase to your bottom line, like you want to do that deal all day long, right? Right. Yeah. So you do it, but the problem is if the only debt available, if you're Mr. Seller and you're trying to sell your property and the only debt available for buyers is 12% private debt, you're just not getting the price that you want to get, right?
By a long shot. And that's just math, right? So I don't care like the housing crisis. I don't care demographic growth. I don't care anything. If the debt is going to cost your buyer 12%, you are not getting the price that you want, that you hoped you were going to get when you bought that property at a 4% interest rate. Just not going to happen. Yeah.
So,
and one thing one thing else that just jumped out to me, because this could be just a gargantuan win if you're able to get deals done. Obviously, right now we spent this last 30 minutes talking about the pain coming. We think it's close, but let's also not forget that building of new units has essentially stopped.
Well, it hasn't stopped. The new permits have stopped.
Yeah, that's what I'm saying. The new stuff. Right.
So new permits. We still have a pipeline of it.
Right.
There's actually a pretty substantial pipeline. It's declining, but we're still, I mean, it's still like we're scheduled still to deliver like 250,000 units this year. So it's not like it's,
but there's a big air pocket building.
Yes.
In 26, 27, 28.
Yes, that's true. Yeah.
And if you could buy distress into this and then you have that tailwind.
Yes, exactly.
Oh my goodness.
Yeah. And that's what happened last time. Like, that's why, that's one of the reasons why there was this misconception that multifamily did well in the Great Recession.
I remember.
It didn't do well during the Great Recession. It sucked wind during the Great Recession, but coming out of the Great Recession, right, a couple of years later, it did amazing because it had several tailwinds. It had all the foreclosed people moving into apartments. It had low interest rates, and it had no new supply, right? Correct. And all those things happened at the same time. Frankly, other than the foreclosure crisis, the lack of the low interest rates and the lack of new supply are the typical bottom of the cycle things, right?
It's coming again.
Yeah, and so that's going to happen again. We will not have the tailwinds of the foreclosure crisis, right? Some areas have good demographics that they'll benefit from, right? But you'll still be if you're buying into that updraft, right? That is going to make you a lot of money.
Yeah, I look forward to what's coming. Again, I've been salivating for a while. It feels like it's not here yet, but it just mathematically has to show up eventually. The balance sheets are so impaired, the assets are so impaired. You got to clean this up eventually.
Absolutely, and there will be great opportunities there. Yep.
Where can people find you?
Yeah, so please find me on LinkedIn. I'm active there pretty much every day, and happy to have conversations with folks there. I am once again, I don't know if you caught this last month, but I'm now doing once a month a free workshop in the first week of the month about how to build an investor list and raise money from retail investors. So if you are interested in that topic, please hit me up on LinkedIn, send me a DM. I'll send you an application for the workshop. It's a free workshop, but it's very limited. So I'm having people apply to make sure that it's sort of the right people in the room. But
yeah, I think that's a great idea. Jonathan, you're amazing, man. Enjoy your week.
Thanks. You too. See ya.